And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show, presented by RIA Advisors.
Well, I think it's best maybe we just play music for the hour. Welcome to Financial Fitness Friday. If you have any finance to be fit for or with, we are here for you. We are here for you. Happy to be here for you. I am here with Jonathan McCarty, CFA, CFP.
Good morning, Rich.
Professor McCarty is with us. How are you doing today, sir?
Well, I was doing great until I saw those futures dip and then thought maybe I should get back in bed.
China's landing a punch. So futures are down again. Dow futures over 1,000. China is looking to impose another 34% tariffs on all imported goods from the U.S. You know, I am absolutely not surprised.
Yeah.
By this move by China. They are not cooperative, and if there's any country I would like to go into a trade war with, it's them.
Yeah.
Other than that, I don't care. I think we were talking about the formula, the overall formula to get to the tariffs that we're seeing, and quite frankly, we can't figure it out. It's some form of quirky girl math. Now, someone said Kristi Noem created the formula. I'm okay with it. But other than that, I don't understand it. I don't think it makes a lot of sense. So I have a terrific headache this morning. You know, it's we were talking about this, Jonathan. It's tough to talk about tariffs only because it's such a landmine politically.
Yes.
Economically, I don't think they work. I don't think we're looking at an overall tariff level we probably haven't seen since the 1930s, right? There are certain countries you are going to have in trade imbalances with, okay? And if you think your children or grandchildren are going to sit in a sweatbox and sew clothes or shoes for Jimmy Choo or whomever's out there, that's not going to happen in the United States of America. Right. Nor it should, okay? We are a service economy, although we have seen manufacturing pick up here due to disruptive supply chain since the pandemic. And frankly, I will say a lot of countries have had the Lance mantra of "get off my lawn" since then, and it's something that Neil Howe talks a lot about in his book, The Fourth Turning, that you are going into more the death of globalism, of globalization, and you're going to see protectionism. It's something that has been going into place.
Yeah.
But to think we're going to have this mercantile economy that certain countries are going to get, certain companies have no place to hide.
Correct. Yeah, we were talking about that before the show.
Right.
You know, this really started and became more prevalent when COVID hit, and everyone realized, oh, we are way too dependent on every other nation.
Right.
But the likelihood that Berkshire Hathaway is going back to a textile company, I think, is pretty much non-existent.
That's right. That's right. I don't know some of the name brands for women's footwear and men too for their clothing. You're just not going to make that here.
Yeah.
And frankly, why should we? But, you know, you've had a lot of companies that moved to China, from China to Vietnam, and now Vietnam is going to have that. But listen, you're going to have trade imbalances with certain countries. I was talking to Jonathan before the show about how the United States is creating this innovative synthetic rubber that's better for just overall globally, but just more durable. It actually was pretty fascinating.
Mm-hmm.
But for now, we need rubber. So what countries do we go to for that? We're going to have a trade imbalance when it comes to certain products. So this shotgun approach versus a surgical approach to things doesn't make a lot of sense to me. Someone is going to pay for the tariffs. I don't care who you voted for, okay, and why, and I understand the spirit of why we do this, but either you're going to pay for it or company margins are going to pay for it. Either way.
And then you're going to pay for it in your investment account. So you're going to pay for it.
You're paying for it. So I think, again, we have to realize that what we have to control are the things that we can control. What we can control is from a financial planning perspective. So when we look at this, yesterday, obviously bonds are working. Yields are falling. Maybe not for the right reasons, but that's a good thing in some form for mortgage rates and so forth. But generally speaking, interest rates are a function of inflation and economic growth. In other words, if my longer term yields are increasing, it's because maybe I have enough economic growth. That's not a bad thing if it's on a measured pace. If yields are falling, it's telling me something's wrong. There's a flight out of risk and people are risk averse, right?
Yeah.
So yields are definitely falling. And so our bonds in our portfolio are the stars.
They are.
S&P is down roughly 8% before this morning's futures.
Yep.
Our stock portfolio, I think, is down roughly 4.2. 60-40 portfolio down 1.24%. That is noise, people.
Yeah, exactly.
I'm not saying don't be concerned. What I'm saying is focus on your financial plan. So I have people that have been calling me. We go through their financial plan and their probability of success, nothing has changed.
Right.
And Jonathan, so maybe share a little bit, because I know obviously with you dealing a lot with clients as well. we prepare for this
We
kind
do.
of situations and turbulence, especially for people in distribution or decumulation mode, right, where they're taking money out of their portfolios. Maybe you want to share some insight into that.
Yeah, exactly. And we do that intentionally with more realistic return assumptions in our plans, to account for this level of uncertainty. I think that it's easy to get caught up in the recency bias of having 20% years the last couple of years, and now we see a little bit of turbulence and everyone thinks, oh my gosh, the sky is falling. But really, we're just coming back down out of the top of the clouds. So we've still got plenty of room to go. It's important when you take a more measured view of how your portfolio could perform in these types of markets and not over anticipate, always missing the downside. And that's something that I talk with clients about. When we're managing these portfolios, we're not guaranteeing that we're never going to lose money. What we're doing is making adjustments on an ongoing basis to mitigate that downside exposure. And I think, as you pointed out, Rich, we've done a pretty good job of that already this year. Half of the equity exposure versus the overall market. I mean, that's a pretty good reduction in risk.
Yeah. It's what you guys deal with it on your own in your own situation. There are some people, because you're going to have this tariff turmoil. For some people, it might cause retirement revisions, but it has nothing to do with their portfolio.
Correct.
It has to do with their mental state about doing certain things.
Correct.
When we get back, we're going to talk about it because there is a psychological element to this. Even if your plan is fine and everything looks great, there's something going on in your brain, something with animal spirits that's going to affect your day-to-day decisions. And we're going to talk about that when we get back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So Java Joe said his long-term bonds are rocking. Yeah. Listen, if you have bonds in your portfolio, you're styling. All this talk about bonds were dead, and Lance wrote all these pieces last year that bonds are far from dead, and your 60-40 portfolio is not dead. The key was or is diversification within that allocation, right? If you're all in tech stocks, you're getting hurt. But there were stocks that were up yesterday.
Yeah. Well, that's exactly why we have position limits.
Utilities, healthcare space, food and beverage, right? Obviously, some areas of consumer discretionary. Listen, people are afraid. You know, you got corporate media out there that the whole world's coming to an end, and people listen to it. Okay? We are advisors. We can't afford to do that. We have to look at it for what it is, right? You know, so I just want to help people understand that you will pull back on your activity. Even people that run financial plans and are fine, and we tell them they're fine, will still cut back.
Yeah.
Because of the fear. So that's just a psychological element that also bleeds into the general economy. Okay. So John Molino, 95% bonds feel so good today. It didn't last year or the year before, but it does show the benefit of having bonds in the portfolio. I mean, I think part of our bond portfolio is up close over 4%. Okay. That's not chump change for just year to date. Okay. So you have to keep in mind, so that's what I have to keep in mind, that you need to make sure if you're managing your own portfolio or you're with an advisor, you got to take a step back away from the headlines.
That's right.
Focus on your goals. Focus on what your benchmark rate is and whether over the last 2 years. So last year, I mean, I think our stock portfolio was up 29, almost 30%.
Yep.
Right? Well, I don't remember what our 60-40 portfolio
I was up just over 13. I think
13%,
it was 13.6 if I'm not mistaken.
13% last year. Yeah. That's right. Close to 14% last year for a 60-40 portfolio. Yeah, last year and the year before, we were telling clients, goal scoop. You want to do this kitchen renovation in 2027. We're going to take the money off the table.
That's right.
And do it now. We had Lance write, listen, you got to curb your expectations. How many times on this radio show, Jonathan, last year did we say that this year was not going to be like this year? Oh, listen, we didn't anticipate this, but we knew it's going to be that, so.
There was going to be some turbulence.
I don't know what Mike Davis is talking about. You guys are Chicken Little. The sky is falling. We got a trade war and 20% of goods. So that's in your head, Mike. We're not Chicken Little. We're trying to tell people not to be Chicken Little. So I don't know what show you're listening to, but you better tune into this show. He's got a show in his head maybe that's going on, talking about that. But we're not being Chicken Little. We're telling people that tariffs are not good, Mike, no matter how you slice it. Go read a history book. Go read an economics book. But we're not Chicken Little. Okay, portfolios are holding up. If you do the right thing, you can manage through this. That's the goal of the show today. You can make it through, and you got to put your minds on how to face that. Now, I will tell you, I talked to a client yesterday, and he said, "Listen, I'm not gonna do this. I'm not gonna purchase the car this year.
Right.
I'm gonna wait." I said, if that makes you feel better, then wait. I mean, listen, if someone wants to avoid a big purchase for a while because something else is running and they wanted it, that's fine. But your plan says you can. Having the confidence to know that you can is okay.
Exactly.
It's just, do you do it or not? And I think that that's the most important thing. So I think as you go forward, and again, I've heard, I don't know, Peter Navarro came out, was on CNBC and said, listen, these tariffs are non-negotiable. But I think President Trump said they are.
Yeah.
And then Bill Ackman, he sends out a tweet yesterday and says, listen, you countries, come to the table. He's a deal maker.
Yeah.
He'll make a deal.
Exactly.
He'll compromise with you. And I think he would. I think if he got a call, because I think the one thing about President Trump is he wants to be liked. And if someone is willing to cooperate, I think he's going to cooperate.
Yeah.
I never expected China to cooperate. I don't care if you put 80% tariff on China, right? Yeah. China is an enemy. So go ahead and do what the heck you want. But there are some countries that we need to work with. What's going to happen is if we do this to some of these frontier markets, what do? If they perceive us as an enemy, they look to China.
That's right.
We're not, you know what I mean?
Diminishing our position in the world stage.
Diminishing our position, right? Yeah. So there are inconclusive studies about protectionism. So Alison Schrager wrote this amazing piece in Bloomberg yesterday. I sent it to my friend Bill Griffith. Bill used to be, when I was studying for the Series 7 in the early 90s, Bill Griffith was on then it was Financial News Network before it became CNBC. Mm-hmm. But he's an iconic, he's been on, I think he was on CNBC for like 30 years. Bill's a really smart guy, and I sent him this article because he does tend to lean a little bit left, and that's fine. I don't care what your political persuasion is, but what Allison does a great job is look at the data.
Yeah.
And talk about here's what it's not good, and here's where they could be good, right? But this rise of protectionism is something we're going to have to deal with, good or bad, because it's happening everywhere.
Right.
And it's been happening, and you said it, Jonathan. During the pandemic, we realized we cannot have vulnerable price supply chains. Especially like the President Trump talked about pharmaceuticals. Why are our pharmaceuticals coming from China?
Right.
Right? We need to do those things. I just don't think we probably should have eased in as one area as we start to build up, because we're not going to build toasters here, and we shouldn't.
Yeah.
Unless they're going to change my diaper in the nursing home, right? then we can build a toaster. Oh, a toaster with legs and arms. Okay. I think I've seen that on the Jetsons.
Well, like we talked about, it would take time to make that adjustment. Trying to do it overnight is going to be very volatile.
Yes.
But ramping it up in the same proportion as you're increasing production, reducing consumption from outside nations, that's a viable policy. And there definitely has been a big push towards protectionist policies. Look at Trump's interest in Greenland. It's not because it's a beautiful piece of real estate. It's because it has a ton of rare earth material that we need. I think it is
beautiful too.
Yeah.
So
I hope it is beautiful.
It looks really beautiful.
But no, it's because
I think your wife might send you there if you don't do anything right.
It's better than the couch.
They have nicer couches in Greenland. I think Amy Perriman said it best. High-tech manufacturing in our chat is a thing, though. And we may lead the world on robot and automated manufacturing. Yes, that's where we should be focused. We should be focused on that high-end stuff.
Yeah, this is economics 101, specialization.
Yes.
Especially in developed nations, using your technological advantage to produce those more specialized materials, that's where you get your competitive advantage.
Yeah, and robots can make purses and other things, but you're not going to get people the jobs unless they're going to be... Look at our percentage of skilled labor in this country. We can't find skilled labor. Right. We can go on a whole conversation about the education system and how people are learning and all that, but we're not going to do that.
There's a reason why the H-1B1 visa program is so prevalent, right? Because we need that type of technical labor.
You nailed it.
Yeah.
So today, I don't know if the headlines are going to, we're going to have non-farm payrolls come out for March. Although I don't know with this whole China thing if it's going to help. And listen, you are definitely obviously due for an oversold bounce. So here's the other thing I want to mention. If you are uncomfortable with this in your portfolio, say you even have a 60-40 portfolio, and you're uncomfortable, you're holding up fine, but it's too much for you because the headlines are getting to you and you want to make a change. Listen, that's okay.
Yeah.
And your advisor should help you do that. But you will have a better time to do it. I get this every market cycle that's rough. Right? And when I first really started in this business, we had the whole 1987, the whole crash. That's when I was sort of working sort of in the business
Savings
at that
and
point. Yeah.
Yeah.
You always get an oversold bounce. You do. Even during the financial crisis, you did.
Yeah.
You will have a better time to go ahead and rebalance. Because when you're in it, you have recency bias.
That's
like
right.
when the market was going up yesterday, how many times, Jonathan, did we talk about last year the water is clear, the sun is out, that's when we worry that this kind of zero volatility,
Calm before the storm.
This nirvana that you're experiencing does not last in markets. It just doesn't. And 5 to 10% moves in markets are par for the course. If you're down 1.2% and you can't handle it, then I would have to say, then maybe you should be getting out of stocks completely.
Yeah.
Maybe they're just not your thing. And that's okay, because you can still get good yields in bonds. You have fixed indexed annuities where you can participate. There are other things you can do. And I have some clients that will tell me, I can't handle it. I'm not going to go back. I don't have this fear of missing out.
Yeah.
We work with them to build a portfolio that works.
Yeah.
And they're perfectly happy.
And that's the job of an advisor, is to work out that level of risk tolerance and capacity for risk with your client.
Yes. So don't let these tariff turmoil or that Tariffic headache cause your retirement to be revised. Now, we're going to continue this theme just one more time. Then we're going to talk about mega Roth conversions, because I want to talk to you a little bit about what if your retirement plans aren't working. Maybe you got your plan run and now your success rate is falling. We're going to talk about why did that happen when we get back.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interests first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
$1 million sounds like a lot of money, and a lot of people don't have $1 million. It's not that much money, considering that most people's net worth isn't $1 million in cash in the bank. That's their house and all their other stuff. That's not liquid. Because if you want to extract the capital from your house, you got to sell it. That's awesome. Where are you going to live?
The Real Investment Show podcast. Same show, your schedule.
I'm going to live in a van down by the river.
At realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA advisors, online resources, and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Bloomberg.
Oh, yeah.
Lance is becoming some sort of Nostradamus. Talking about how 10-year Treasury yields could get to 3.5%. Well, they're at 3.882%.
And falling.
Right.
Yeah.
Yeah, Lipscomb's right. 50% of Americans really don't invest in the markets. They have no investments. So if Democrats come out and start lamenting about the stock market, they really shouldn't be doing that.
Yeah.
Because if they're dealing with working people, a lot of working people don't have stocks.
Correct.
Right? We got to worry about how tariffs might affect working people. Middle class, lower middle class. People, working people that they spend every dollar they have, right? They don't save anything, right?
Yep.
If you're wealthy, you're managing the storm, you'll be fine. You're going to make it fine, right? And we know a lot of wealthy people that have a lot of cash, and they're going to weather this just fine,
Yep.
right? But so someone on the chat mentioned about gold and silver. I have nothing wrong with gold. I have nothing wrong with you taking a percentage of your money and looking at any other asset class. Jonathan was just, I was just talking about Bitcoin, the safe haven. You know, if you wanted to buy Bitcoin and you feel like you missed the boat, you may get another chance to get on the boat, but you won't.
Yeah.
Yes, you won't.
Because then you'll stop and wait. Oh, it's going to come a little further, and then it'll turn around and bounce 10%, and you're like, okay, maybe next time.
PIMCO wrote all this great stuff during the financial crisis. I would follow them. Paul McCulley would write that you think you're a value investor. You're full of crap. He would write this kind of stuff like, before he became a hippie. Mm-hmm. And because he's a genius. Like, then he just went off and I think he's on a meth farm or whatever. But I mean, he's with the birds and, he's got a ponytail now and all that. But the guy's a genius, right? Paul McCulley, he was just like this. He was the thinking man at PIMCO, like with Elilarian. Mm-hmm. And he would talk about, you think that you're a value investor and you can buy value. You're so full of crap. You're never. When things are going down, that's the last thing you're going to do is buy.
Yeah.
You're just not. But if you did want to own Bitcoin, and again, it's not a recommendation, you might get a chance to do that.
There might be a nice entry point. Absolutely.
Gordon is talking about Shania law.
I think he means Sharia.
No, he said Shania, so I'm thinking Shania Twain is now doing law. And if Shania Twain wants to initiate any kind of law against us, I'm okay with that. Like if she came up with the formula.
We check out with the math we were using.
If she came up with the crazy tariff math that I've never seen before, I'm okay with Pam Bondi, Catherine Levitt, Carolyn Levitt, Shania Twain. Any
Checks
of you
out.
all want to come up with a formula?
Mm-hmm.
We're fine.
Then
We
you
got
really
a
feel like
formula,
home.
even when Jonathan has to sleep on the couch.
Yeah.
We got a formula. So
I don't think there's a formula that can calculate that frequency, Rich.
did you try it in ChatGPT?
I should.
How long will Jonathan McCarty be sleeping on the couch? The
8 ball, yeah.
The
Okay,
8 ball is
let's-
just as good as ChatGPT.
Let's roll the dice here, guys. Hang
Do
on.
you think...
It is decidedly so. Like I said, there's no calculating that percentage chance, guys. It's basically a certainty.
Oh my gosh. So there are people, and we get them, who are going to come to us sometime in the near future. Their plans aren't working.
Yep.
Their probability of success will change dramatically, even with just a week of turmoil. Why is that, Jonathan? What do you think?
Well, I think it's because, their spending rails, right, may be a little bit too wide. We may need to tighten up what their expense estimates are on an annual basis, kind of put in some safeguards as far as what we're dedicating those funds for. It's easy if you're over risk exposed as well. When you have these type of turbulent markets, that can drastically impact the overall viability of your plan. So if you have too much equity exposure, too much risk in your portfolio, and you're seeing a lot of fluctuations in your overall investment strategy, you've probably taken on too much risk in pursuit of higher returns, which means you may be a little underfunded on your retirement plan.
Yes, and also you're probably using historical returns.
Also true.
In your analysis, right?
7, 8, 9%.
You're going to get 9-10%
Right.
every year consistently, and that's fine. Joey Sock says that his cat's got to switch to generic food from Fancy Feast. When you're in a recession? When Joey Socks is eating Fancy Feast.
That's
then
real
we know
recession.
that, man, those commercials for Fancy Feast used to be good. They just open the can, and the fork would go in, and all these chunks of chicken and stuff, and the cat would get all riled up. And I'm like, oh, that tastes good. I'm better. Listen, Gordon, I like Shania Law better than Sharia law. I think they'll be fine. So today, if you have bonds, you're good, right? Now, again, we got this number coming out, this non-farm payroll number. I don't think that's going to move this general news here.
Not after the China announcement.
This is going to overwhelm everything. I don't care what average hourly earnings are and all that. This is...
Yeah.
You might get a blip during the day that if the number's fine, you might take a few hundred points, but for the most part. Yeah. So here's the thing, too. So this is interesting. I'm watching CNBC here. We got CNBC up. We got Bloomberg. We got all kinds of things up. Alternative asset managers hit hard. Most firms down more than 25% year to date. So here's the thing. You always think of alts as an amazing diversifier and protection sometimes. See, diversification and protection are not words that should be put together.
Correct.
Just because you're diversified, you're still going to feel the brunt of things. Diversification is not some magic formula, but you people that will go in and be sold alts because they think that it's going to protect them better during down markets. That is absolutely has never been the case.
It depends on the strategy of the alt, right?
Yeah, but a lot of alts are leveraged alts.
Yes.
In other words, they'll do really well, but a lot of times people think all these fancy things are going to protect them during bear markets, down markets. And a lot of times that shows that that's not the case.
Well, a lot of these alt strategies, like you said, Rich, they're leveraged. So they're dependent upon their collateral to maintain those leveraged positions. Well, if everything is falling and your collateral is collapsing, you're going to have to unwind some of those positions at a less than advantageous time. And that's going to definitely hit you hard.
Absolutely. Absolutely. So the one thing I would say is, Lance said this yesterday. I don't know if I agree with it so much, but it was more of like, go off, play golf, don't watch the news. In some ways, that's true. But I also think that you do need to look at your stuff, your portfolios. You do need to understand how you feel in your gut, because these are the times your real investment attitude, your real who you are as an investor.
Yes.
Like there's a point in movies, they always talk about the hero's journey.
Mm-hmm.
And when you write scripts, and the hero always, you have to torture your hero. You've got to put him into this place to see their true self.
Right.
They may not start out as heroes, but when you put him in a situation, right, and you put him up against the wall, and it's just that point where they can't take it anymore, they rise.
Yep.
This is your point. If you don't know what kind of investor you are, you're going to know. That's why I think you absolutely should look at your portfolio.
Yeah, and I think during these times of turbulence, Rich, we see exactly what you were talking about. The true thoughts around risk and volatility that clients have come out. We do a number of different behavioral finance based questionnaires for our new clients to come on board. And then we review those results with the clients, and they sometimes line up. And then you find out sometimes when you get some volatility, maybe they don't line up quite so much, because people who say, "Oh, I'm comfortable with this level of volatility," for example, a 5 to 10% correction, I'm comfortable with that. Well, here we are in a 10% correction year to date in equity markets, And not all of those people who said they were comfortable with that are still comfortable with that. So it's a good way for advisors to go back and connect with their clients and reconnect, make sure that they are actually in an appropriate allocation model for their level of risk tolerance and their ability and the capacity to take that risk.
Right. Larry Smith. Larry is just Larry.
On fire, always.
Lance wasn't talking to you. You need to. I know Lance wasn't talking to me. I'm saying he was telling people on the radio, go off, go play golf. And I do believe in some of that, although I'm not playing golf. That's the most boring freaking game I've ever. Sorry for you golfers, but hitting that little ball, I mean, what's the point? I don't get it at all. I don't get sports at all, so that's just me. So, but I'm saying if you are an investor, I think you should look.
Yeah.
And then whatever you're feeling, realize this. Maybe this kind of downside move isn't normal, but volatility is normal for markets. If you can't handle it, or say maybe your allocation was right. Maybe you haven't spent time with it.
Yeah.
Now is your time to spend time with it. Not to make some knee-jerk moves and, go ahead and take a machete to it, right? But go in and adjust.
Yeah. And we even see the other side of that coin, Rich, when in times of like this, we also see the clients who are actually more aggressive than maybe their responses have indicated. I've got clients that are calling me yesterday saying, we should buy. We should definitely buy right now. So, there's opportunity in the market. And we talked about it a little bit, Rich, that there were still sectors that were up yesterday. Even in the face of all of that red, there were still some pockets of the market that were still positive.
Topher says you shouldn't have to rebalance out of fear. Yes, you should. You should rebalance out of fear because your timing, you don't do it during periods like this, but this is telling you what you're holding is not working for you. Okay? Use the fear productively. Use the fear to understand who you are, then come up with a claim plan to rebalance. But these are the times you're going to look at a ghost and you're going to crap your pants or you're going to face it. And when advisors tell you not to worry, I think that's a bunch of bull crap. I think you need to.
Except to my clients. When I tell you not to worry, don't worry, guys. Yeah.
Yeah, when Jonathan says don't worry, don't worry. We got to go because Brent's harassing me. We'll be back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, if you're turning, say you're 60 to 63 this year, you're getting a super duper way to supercharge your savings, right? You're able to do much more as far as your catch-up provision.
Yep.
Now, so obviously when you do your normal salary deferrals, you can do more, but you could do even more this year. But the problem is there's a lot of employers that are saying, nah, we're not doing that. So even though you're supposed to, the employers don't have the systems in place to allow you to make these super duper.
Yeah, the plan still has to have that option.
Exactly.
Yeah.
So even though you may have the option, you may not have the option. So there are people doing backdoor Roths, right? They fund an after-tax traditional IRA every year. Then they take that money, convert it into Roth.
Right.
Perfectly fine if you have no other IRAs, right? Most people have IRA rollovers and other things. Then this backdoor Roth, this backdoor Roth loses a lot because of the pro rata rule, right? In other words, the government pools it all together. Look, I have clients that specifically will not have IRA rollovers. They'll keep their money in their 401ks so that the only IRA they have are these after-tax IRAs, and then they convert them to Roth. That's the best way to do it.
Yep.
And I have clients religiously who do that every year. Great strategy. But what's this mega Roth? Mega backdoor Roth?
Yeah, so the mega backdoor Roth, it's increasing in popularity, but to Rich's point, not every company has this option. But
right.
Essentially what it does is it allows you to maximize up to what I think it's 70,000 now is the maximum, Rich, was 69 last year.
Yeah.
So you can maximize your contributions to a 401k plan over and above the typical limits. So the typical limit, I think it's 23,500 plus your catch up if you're over 50 is another 7,500, or between 60 and 63, I think it jumps up to around 11,000, a little over. But then you can fill that up with after-tax funds up to the $70,000 limit that will either, depending on how the plan is set up, go into the Roth portion of the 401k plan, or it can be put into an after-tax holding account and then rolled into a Roth IRA.
But your plan has to have it.
Correct.
The plan has to allow after-tax.
Yes.
Now, I know a lot of companies that will actually promote to their employees, almost as if it's a benefit that they're providing to their employees, that to have this mega backdoor.
Oh, it's a benefit we're providing to you because we're required to.
But they make it sound like, oh, we're giving this to you, and you should love us for that.
We're a family.
But that's not the case. It's just that they're going to have to, because keep in mind, by 2026, right? You're, depending on how much you make, I think it's what, 145,000?
Mm-hmm.
All your catch-up contributions
must be Roth.
That's so right. This has to be retooled, and there are a lot of companies that weren't ready.
Yeah.
To do that. So all this talk about, I always call the Secure Act the Rothification of America, the J.G. Wentworth syndrome, right? The government needs cash now, because everybody's saying, I'm worried that the government will take Roth away. They're not. The fatted calf is your pre-tax IRA.
That's right.
Why do you think non-spousal inherit IRAs now have this truncated distribution strategy? To get the money sooner.
They want those taxes.
Maybe in 50 years, Roth would be the case. But the number of Roths versus the number of pre-tax, after we've been sold a bill of goods that, this pre-tax thing is the best thing since sliced bread or cheesecake or Christine Nome. It's not. It's not.
Yeah.
Right? I mean, it worked when you had these super duper years in the markets. But then when you retire, in the old days, when I started, you were told that people, and retirees are going to fall all the way down to the lowest bracket. So everything pre-tax was great. But Jonathan, what we find now, even people with reasonable incomes, that's not the case.
Right. I mean, you look at pension income. Individuals have pension income, they have an annuity income. So you may have a number of different income streams while you're retired that's already going to push you above the lowest tax bracket. So that right there is already eroding the value of this pre-tax strategy. So, and that's assuming tax rates stay the same. And we've talked about it a number of times on the show, Rich. I don't really think that's likely to occur. So if you have the opportunity to maximize your Roth contributions, you should definitely take advantage of it. And we talked about it before the break. If you're concerned about your plan or if you're on the borderline of success of your plan, this is your opportunity to pad those numbers before you retire to make sure you don't have to have those types of worries keeping you up at night.
So I was in this financial planning chat room, and all the planners, there's a Tax Cut and Jobs Act setting in your plan that says that it sunsets or it doesn't. And everybody's so confident that President Trump's going to get through. That
no one's expecting it to sunset.
And I'm like, you guys are crazy. This is not going to look the same. And the president's losing clout every day.
Yeah.
Even with Republicans. So my thought is that this Tax Cuts and Jobs Act is not going to look the same. They're already talking about SALT concessions.
Yeah.
So as planners, there's no way I'm going to check off that this thing is going to sunset.
Well, look at what just happened. The Senate voted to overturn the Canadian tariffs. That means Republicans flipped. So, yeah, you're correct, Rich. I think there is definitely some erosion of support on the Republican side, concerns about midterms and how that's going to look. That's going to drive motivations for passing any package.
That's right. That's right. And whether you like tariffs or not, and if you're a Republican, you have to worry about midterms.
Yeah.
You have to worry about midterms. Okay? So your candidates or your people you elect may have a longer-term view, but Washington is day-to-day. Right?
That's right.
You're loved on Monday and you're despised by Tuesday. Like, who wants to live in that kind of environment, right?
Elon Musk.
We do. We work here. But what I'm saying is that we can't. I agree with you. Even with all the Doge tax cuts, I don't see any cuts in budgets. Doge is saving. I think as Washington looks at it, yeah, go ahead and make those cuts because now we got all that more money to spend. Mm-hmm. They're just going to fill it up again. It's like a bucket. Because remember, we only have 4 years, not even. That goes by it's not a long time. President Trump says that's a long time. 4 years is not a long time.
It's not, no.
I mean, the guy feels like he's going to live forever. I understand 4 years, right? And he's pretty active. But 4 years is fast.
Yeah. And it's
and
interesting.
All this can be changed.
And yeah, it's a great point, Rich, because that's exactly what happens. When we have different administrations come in, they try and get as much as they can done as far as their platform, try and get as much accomplished as they can because they know
the first 2 years.
Right, because they know in 4 years there could be a new administration, and that administration and that political party is going to do everything they can to reverse course and do their policy initiatives. So it's this constant back and forth that we have between the two political parties in this country where they're just trying to get as much as they possibly can done in such a short window. It's not always, in my opinion, the best thought out plans.
So my thought is I don't think the Tax Cuts and Jobs Act is going to continue. I think it sunsets or it looks totally different. Is in a totally different box to check.
Yeah.
It doesn't look the same. And they're already talking about that.
I think
so
that's
we'll have
accurate.
to wait and see. So as a planner, we just can't make this assumption and be overconfident. So we got to plan for what we have now and then change when things change. But we can't anticipate what it's going to look like.
That's right.
So these Roth conversions, especially with where we are from a debt situation, Roth is a very valuable tool in your box. And more people, it seems, even people that weren't on board with it, because now I have to turn people away. I'm like, listen, you don't need to do a Roth.
Doesn't make sense.
I'd never say that, but now I'm saying it. Like, I run the numbers, it's not working, right? So, because I think I should do Roth. I need to do Roth. Well, no. I mean, you got to run the numbers. If the numbers don't work, then you don't. But it's amazing how this whole Roth thing has caught on.
Yeah. Well, I think people are concerned about retirement. One of the biggest concerns is cost of living changes. So if you're looking at where can you cut back, well, paying less in taxes looks very appealing.
Right. Because remember, Social Security is taxed.
Right.
So you have to take your tax rate, multiply it by 1.5, 1.85 to get an idea of what your actual tax rate is. Because we don't look at that. We look at marginal rates.
Yes.
And we say, well, I'm in the 22% bracket. No, what's your tax rate? Let's look at that. And then we have to multiply it depending on where you're getting hit on Social Security taxation. That adds to your tax burden. But those are always looked at. Or maybe you're hitting the levels for IRMA, right?
Yep.
On Medicare premiums.
Yep.
Those are taxes. I call them backdoor taxes because you don't spend a lot of time look at that.
But they're still taxes.
Yep. We have to look at that, right? We have to make that decision to look at those things for you. So overall, Roth is a very good thing, especially younger people. When younger people come in, Gen Zs and so forth, they're just starting their careers, I get them right into their company plan, Roth.
Absolutely.
Right? Also because they're in their lower earning years and they're going to hopefully be in higher earning years.
Yep.
If they have so much in Roth in the beginning, think about this. Once they're in their higher earning years, you actually might say to them, listen.
Use the pre-tax. Yeah. 100%.
It's like you're the alt Superman or something. You actually might start blending the assets to take advantage of that tax deferral.
That's right.
As opposed to it being, it's great for everybody. No. Yeah. There's a way to phase it in depending upon where you are in your career path and how much money you're making as well.
Dial in that effective tax rate.
So listen, we're going to have a lot of events coming up, more Candid Coffee. Stay tuned. Lance back on Monday. Sign up. RealInvestmentAdvice.com. Listen, we're going to be writing all about this stuff. Read the newsletter. Sign up today. Hope you all have a great weekend, everybody. Take care. Even you, Larry.